Hi guys, welcome to our channel. My name is Zahir Anwari, co-founder of Sublime Trading. In this recording, I'm going to go through how to have a multiple screen setup to conduct your analysis in the most effective and efficient way, regardless of what asset class you are looking at. So first and foremost, let's have a look at a typical mistake that people tend to make, and that is that they often look at the wrong timeframes, and that is the intraday timeframes when doing their analysis. So the screen you can see in front of you is that of the 5-minute time frame, and we're looking at the S&P 500. Now, looking at the chart itself, you can see that there's not really a clear direction to it. The market's just going sideways, then we have this drop down, there's a gap, then the market starts going sideways and it starts picking itself up. If I compress the chart, you can see that it gets even worse. It's just whipsawing down, whipsawing up, goes sideways, whipsaws down. This is what tends to happen on lower time frames. There's not really a clear direction to the market. Good analysis or simple analysis is really being able to establish environments where markets go up in a very clean way or go down in a very clean way. If markets go up, it's a bull market, we go long to make money, and of course today we can short the market, which is a great position to be in. So when markets do start moving down for sustained periods of time, known as bear markets, we can short the market. But it's very difficult to catch these big moves that last days, weeks and months when you are trading on the lower time frames. Now, of course, intraday trading, day trading, scalping, however you want to call it, is sold as the sexy way to quick riches, and people get caught up in this, and then they often find out that it's not as sexy as it's being advertised. The money is made by holding positions for weeks, months and years, and then compounding, something that we will cover in future videos. So if I just go up to another time frame, so at the moment we're looking at the 5-minute time frames, and you can see regardless of what time frames you use here, the intraday time frames, it will all be the same, even when you go into hours. I mean, when you start going into the 4-hour time frames, it's slightly better, but what you want to be looking at is the daily time frame as at a very minimum. Now, if you have a look here, we go from the bottom left to the top right, we have a clear direction to that market, to the S&P 500. The 5-minute time frame we were just looking at, it's somewhere in this most recent candlestick. That all of that price action, all those candles we were looking at, it's somewhere in here on the 5-minute time frame. Whereas if we look at the daily time frame, got a nice big move to the upside. If you look across the bottom, we can see that data is going all the way back to April of last year. That's April 2020. And of course, if I compress the chart, I can get more data in. But just looking at the default setting, there's a lot more data coming through, and you get a much clearer picture to price action. If I go up to the weekly time frame, again, you can see from March, April of last year, this is where the data that was starting in the bottom left actually starts from here. On the weekly time frame, we get a lot more data coming through all the way back to 2016. And then of course, if we go to the monthly time frame, we have data going all the way back to 2009, which is where this bull trend came in. And again, if you remember that 5-minute time frame we initially looked at, somewhere in this most recent monthly red candle. So much data on the larger time frames. Imagine getting in your positions in 2009 and just holding those positions. You compare that to on a 5-minute time frame, it's just not possible. So you make it really difficult for yourself to gain any consistency when you're trading on lower time frames. Move up to the higher time frames, because that's where the money is made, the monthly, the weekly and the daily. Big moves equate to big profits, and with you doing far less work. And remember guys, you should be busy. You'll probably have a job, you're probably employed, business owner, married, kids, hobbies. You have a lifestyle, and then to try and day trade and scalp or whatever the case is with all of that going on, it's just a very, very difficult approach to sustain. And ultimately it doesn't work. All of that time and money for very, very little profit. So be smart, move to the higher time frames, do less, make more. We work hard in our jobs, there's no getting away from it, but work smart when you're in the financial markets. And so because the monthly, weekly and the daily time frames work so well, we might as well have them set up on one screen. So if I go to the next screen, that's exactly what we have here. This is a typical screen setup, a typical chart, multiple screen setup for me when I'm doing my analysis, regardless of which asset class I am looking at. So UK stocks, US stocks, commodities, currencies, even cryptocurrencies. I have the same multiple screen setup regardless of what assets or asset class I'm looking at, simply because it works. It gives me a very clear picture of what price is doing. And remember guys, price should always be a number one indicator. I'm going to load up a few technical indicators on here just to show you how my screen looks, but price has to be your number one indicator. All indicators, moving averages, stochastics, RSI, whatever you use, they are all lagging indicators. They're based on price. So price comes first, those indicators are calculated second. So always focus on price and let price dictate. Use these other indicators to give you an edge. So let's get into this. In the top left corner, I have the monthly time frame. In the top right corner, I have the weekly time frame, and across the bottom, I have my daily time frame. Because I've got all three time frames on the screen at the same time, I can see very clearly what price is doing. What I'm looking for when looking at all these three time frames together is alignment. Ultimately, I want them all moving in the same direction. To the upside, that's a bull market. All moving to the downside together, that's a bear market. If the monthly is moving up, the weekly is moving up, and the daily is moving down, then there's no alignment. So that's what's good about having this three screen setup. I can see exactly what price is doing and how aligned they are. So if I open up the monthly time frame, there's a couple of indicators that I have on here. The first indicator is the high and the low of the previous year. And then I also have support and resistance levels. In future videos, I'm going to be breaking down each time frame in more detail so that you know exactly how I use these tools. But in this video, I'm just going to give you an overall look and feel of what my three screen setup looks like. But in short, guys, when you have these levels in a bull market, you want price to be above all of these levels. In a bear market, you want to be seeing price trading below these levels. So very clear levels of support and resistance on the monthly time frames. The high and the low of the previous year, so as this is being recorded in 2021, the high of last year is 2020. This is the low of last year, which is 2020. What I'm looking for is price to be above the high of last year for it to have a bullish bias, or below the low of last year for it to have a bearish bias. Prices inside these levels, I stand aside. So if you look at the S&P 500, it's trading above the high of last year, so it has a bullish bias. Again, as already mentioned, I'll be going through this in more detail in a future recording. Now on the weekly time frame, I have the 200 simple moving average and the 50 simple moving average. If I just open that up, these are averages. So this is giving price, the average of price over 50 weeks. The black line, which is the 200 simple moving average, is giving the average of price over 200 weeks. Now, if you're not aware of this, what is the logic behind the 200 simple moving average? Well, old school traders had to draw charts by hand. We don't have to. We have software that does all the work, all the calculations for us. But you can imagine old school traders didn't have that luxury. So they had to draw charts by hand, which is a long, laborious process. And so they were very, very selective with the tools and indicators that they put on their charts. The 200 simple moving average was one of the first indicators that went on the chart because it was a proven indicator of the long-term trend. If price was above the 200 simple moving average, they would go long. If price was below the 200 simple moving average, they would go short. The 50 simple moving average is a very good area of support and resistance. So support in the bull trend, resistance in the bear trend. So in short, guys, I want to see price above the averages in a bull market, below the averages in a bear market. And if I open up the daily time frame, similar setup. I have the 200 simple moving average, one of the first indicators to go up on our charts. We have the 50 simple moving average, which is a proven area of support in a bull trend, resistance in the bear trend, and then also the 20 simple moving average, which is also a very good area of support in a bull trend and resistance in a bear trend. And that's it, guys. This is typically what my three screen setup looks like. Monthly top left, weekly top right, daily across the bottom. I've got my key levels of support and resistance on the monthly time frame, and moving averages on the weekly and the daily time frame. And as already mentioned, these charts are very clean. There's not a lot of clutter on there. I'm still using the old school techniques that old school traders and investors used to use. The only difference is that we don't have to draw that because the charts are, the software is doing that for us. Now what this does, this very simple setup, is define a proven edge. In investing, good trading, you have to have an edge. If you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. An edge is where you can define environments in the market where you have more chance of making profit than a loss. Now remember, this isn't a guarantee. Everything's based on probabilities, and so you still need to have risk management in play, stop losses in play. And again, we'll be looking at all of these techniques in future videos, but for now, analysis starts with having the right screen setup and the right tools on your chart, and this is a typical setup for us here at Sublime Trading. Now I'm just going to show you the final screen. The final screen, actually, where we do our analysis, has more bespoke tools on there, more areas of support and resistance. We have trend filters that very clearly define breakouts in a trend and pullbacks in a trend. We've got the monthly in the top left, we've got the weekly in the top right, and we've got two daily charts, bottom left and bottom right. The daily bottom left is where we do our analysis. The daily in the bottom right is where we have our entry levels, our stop loss levels, everything that we require to calculate our positions and put them into our broker account is all found on the daily time frame in the bottom right corner. Okay, so I hope you enjoyed that first video, guys. Adopt this screen setup, particularly the 3-screen setup that we have here, because this is really where you want to be conducting your analysis. And then once you've got a good screen setup to conduct good analysis, you can then take that further by learning how to execute a strategy to extract profit. If you have any comments or questions, do leave them below this video and we will get back to you. And also in the description below, I will leave some links to come through to our free Facebook group, our newsletters, and all the other amazing free content that we put out. See you in the next video.